It's time for the Your Personal Bank Show with Ference Toth, financial literacy educator and speaker, entrepreneur, and chairman of the board of a bank in formation. Take charge of your financial future with your personal bank. Now here's Ference Toth.
Welcome to the Your Personal Bank Show. And I'll tell you what, today's show is going to be titled, There's More Than One Way to Skin a Cat. I thought you might find that quite interesting. And what I mean by that is this is really what I'm going to talk about is some various ideas here that I've been sharing, and this really comes from you, the listeners, I should say. There's been a number of folks I've talked to here recently, in fact, two of them today, that are radio listeners that, they've been listening for a while, and I do really appreciate it. I get that a lot. It's the comments have been, like I said many times, extremely positive. Like they often say, like your outlook on life, and realize there's a different way of doing things, and sometimes a different way of thinking about things. Notice we don't always have to do the same thing over and over again, and like everyone else, for example. And by the way, the definition of insanity is doing the same thing over and over again and expecting different results. There is a different way to accomplish your financial goals. Here's the thing. Not everyone has to put most or all of their money in the stock market, for example. I get this all the time. Now, if you've done great in the market, awesome. And if you're comfortable with it, kudos to you. But I would also say that if most or all of your monies are in the market, diversification is probably something that you should really consider. I think most people would agree with that. The thing is, in terms of, I say this because it's so often, I run into this so many times, been doing this financial stuff for over 20 years, I should say, probably about 24 actually. Anyway, the thing is, when I talk to people all the time about their financial goals, looking at their financial statements and their situation and what they're really trying to accomplish, and asking them, why do they have the accounts that they have, for example, and it's amazing to me how many times I hear the answer I get is, well, it's just because this is what I met with somebody and that's what they told me what to do. Or I'll hear, well, I didn't know what else to do. Seemed like the right thing. Neither of those are really good answers when you think about it. Just because everyone else does it doesn't mean that's a good reason for you to do it. I mean, we all remember, all of us probably had moms at one time that said, look, if Johnny would jump off a bridge, you're going to do it too. Or, when we were kids, we say, well, my friend gets to do it. And the parents, of course, our answer always is, well, I'm not their parents. You know what I'm saying? It's that kind of thing. Like I said, the market can be great for a lot of people, but also there's a lot of folks out there that it's not so great for. And what I mean by that is there's a lot of people out there that are just not comfortable with risk or the degree of risk that the markets inherently, that are inherent to the markets. Let's face it. In fact, study after study shows that the majority of people, and by the way, human nature, it's something like around 80%, are not really comfortable with the level of risk that, say, the markets provide. I've seen studies where it showed asking questions, things like, if you had an investment that would make, say, 8%, for example, in good years and could lose 8% in a bad year, for example, versus one that just made 4% every year, typically around about 80% choose the 4%, guaranteed, consistent. It's really amazing, actually. So the thing that I want people to understand, I'm not knocking the markets. I'm not knocking people that have done well with the markets. Again, what I'd say to somebody who's done well with the markets and is comfortable with it, that person I would discuss diversification, because that just makes sense. And I don't mean diversification in terms of diversifying into different sectors on that type of thing. What I mean is diversifying in a non-correlated asset. Now, what is that, you say? A non-correlated asset, quite simply, is an asset where its value is not dependent on the same set of criteria. And that's why, when they say diversification, it used to mean, things like, well, have some money in the market, maybe real estate, or, precious metals, or your business, or various other things like that. Those often are not correlated assets, okay? Also, guaranteed or fixed type of income can be a non-correlated asset. It's more interest rate based and has underlying guarantees. That can be a non-correlated asset to say one that had, subject to market risk, for example. So my point is, even for somebody who is comfortable with the market and the risk that's involved and has done well with it, and that's, their comfort zone, right? I still would say diversification is an important key, and that's where your personal bank can really fit in for that type of person, certainly. But I want to talk to a minute for the person that maybe isn't all that comfortable. And like I said, that person doesn't need to feel bad because, frankly, human nature studies, like I said, over and over again have shown that the majority of human beings are not comfortable with that type of risk. Okay? I can tell you my wife is one of those. If you just even mention the word stock market, she kind of cringes. And it's not just stock market, it's just anything with risk. She's just, she's more secure focused. And generally speaking, again, this is a generalization, but women tend to be more security focused and men are more risk focused. And that's just kind of how we're built, if you know what I mean. It's often, I tell another story, this is pretty funny, it kind of drills down to this very issue. I remember many times sitting down with couples, but this one came to mind. And basically, I was looking at their investments and everything they had, and I asked a simple question. And I said, and I could tell they weren't on the same page as a couple with their financial goals. By the way, it's much more common than you may realize. And just from talking to them and listening to some of the things they were saying, there was some friction. You see, folks, and like I said, a lot, I'm talking to you guys for a minute. We can get a little tone deaf to that, and it can cause some friction in our relationship if we're not listening to our partner. We all know this as a guy. If you don't listen to your partner, things aren't going real well, probably. Again, financial stress or financial not matching in your financial goals can be a real source of stress. So one of the simple questions I ask often, and I ask this particular couple is, I gave them each a piece of paper and a pen. I said, I want you to write down a percentage of your total investments that you would consider, that you would think should be safe or guaranteed. Okay? And so they each wrote, and I said, and then I want you to pass those papers to each other. So they each wrote down a number, and they passed it to each other. And this was the responses were actually fairly typical. They each wrote 25%. Now, it was interesting. Oh, I'm sorry. The wife wrote 75%. The husband wrote 25%. And the wife looked at the husband, and she said, oh, you mean 75% guaranteed? He said, no, 75% at risk. She wanted 75% guaranteed, only 25% at risk. In other words, their goals weren't aligned. And this situation was pretty intense, I could tell. I mean, literally an argument broke out in front of me. And then as they were talking and it started getting more heated, the husband even said, I just wrote 25% because just to make you happy. I really wanted 100% at risk. And then that kind of threw her over the edge. And I had to kind of be the referee and intervene at that point. And I said, whoa, let's stop a minute. I did this exercise for a couple of reasons. One, I wanted you each to express yourselves and what was important to you and where you felt you should be as a couple. And this was a couple who had been married for quite some time, frankly. Again, this is super common, all right, far more common than most people realize. And I just basically said to him, look, I said to the wife first, I said, the reality is it's clear that you're more security focused than he is. She said, oh, that's true. And they kind of talked about that a bit. There's no question about it. I said, that's not uncommon. It's not always that way, but that's the more common scenario with a couple. And then I looked at the husband. I said, it seems pretty clear that you're much more the risk taker in this relationship. And they both agreed absolutely that was the case. And I said, here's the thing. Here's the beautiful, powerful thing about being in a relationship and having the differences that we have. the differences, opposites attract. I mean, one of the things I've often heard said, it's kind of funny, is if both agree all the time, one of us isn't necessary, right? But the thing was this. I said, the beautiful thing about the differences are, and I looked at her, I said, here's the reality. When it comes to your money and your investments and your future and retirement, all those kinds of things, you're probably more security focused than maybe is the best mix. And she agreed. And I looked at him and I said, and you, the same, probably are overly risky. Frankly, the middle ground, somewhere in the middle, is probably where you should be, because that way you both could compromise a little bit, but then both be happy, if you know what I'm saying. This is an important topic because so often I hear this, and it's sad, but I talk to couples and they'll say they meet with a financial advisor or whatever. And often I've had many of them say, well, I told them I don't want any risk, or I want a very limited risk. And we look at what they have, and well, frankly, they're far more risk than they realize. And frankly, the advisor just didn't listen to them. Let's be real. I see that so frequent. So what I want people to understand is your personal bank is, you can build wealth through your personal bank. Many people have, over decades and decades, actually for over a century, have built wealth this way. This is a viable alternative to building wealth. And we're going to talk about some of the other options that are out there, but it has some real inherent benefits. One of those is the underlying guarantees, the safety that's involved, the consistency, steady, eddy growth you can get. Again, we have companies paying 6% dividends, even today, who've paid 6% every year for the last 25 plus years and never missed a dividend since literally before the Civil War. Folks, that is an incredible track record. And they're well positioned to continue to pay those dividends going forward. There's also tax benefits. You can actually, setting up this properly, you can grow your money income tax free. You can access it income tax free and pass it to the heirs income tax free. That is powerful too. So what I want you to understand, and then the last part of it, of course, is with incorporating the bank line of credit and getting paid more in dividends than you're getting charged in interest, when you do access the funds, you create positive arbitrage. You earn interest on money you spent. I'm going to really encourage you to stay tuned on the next show, or next segment, I should say, because I'm going to go into this in depth and further and talk about more things that are very impactful. So stay tuned.
For more information on your personal bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show, and today we're talking about, well, there's more than one way to skin a cat. And what I mean by that in terms of financially, again, I have a lot of folks that come to me and listen, and again, I really appreciate the feedback. It's been really overwhelmingly positive because, like I said, not everybody fits on the same doing the same thing. And overwhelmingly, I find from people I talk to, meet with, and various folks, they're overwhelmingly invested most, if not all of their monies, frankly, in the stock market. And many of them, frankly, the majority, are not comfortable with the level of risk that they're actually taking on. They're doing it because many of them feel like what other option is there? Or this is what they were told what to do. Like I said, if you're comfortable and you've done well with it, more power to you. Again, I would say to you, if you're mostly or all allocated into the markets, you probably should diversify into some non-correlated assets. We talked about that in the first segment a little bit, and I would really encourage you to go back to that if you missed it. Go to yourpersonalbank.com. You can listen to any of the previously recorded shows. But the thing I'm going to say is, it's okay if you're not comfortable with the level of risk that you have, or you want to diversify some more. You don't have to feel bad about that. In fact, the majority of people, studies have shown human behavior, that something like approaching 80% are really not comfortable with the level of risk they have with their investments and their money. And we're at a time where we're in uncharted waters for the most part. The markets are at or near all-time highs. Interest rates are low. That's a big reason behind it. The economy isn't necessarily overly strong. We're still getting over the hangover effects of the COVID shutdowns. Unemployment is still far higher than average. We've had, mortgage and rent moratoriums that are going to expire soon. How's that going to impact things? What I'm getting at is I'm not trying to scare people. I'm just saying there's a lot of uncertainty and a lot of people are concerned about it. Of course, the level of debt that our federal government has taken on and continues to do concerns a lot of people, as I think rightly it should. The thing is, I want you to understand is if you're not comfortable with the level of risk where your money is invested, it's okay. There's another option. That's part of the reason why I do this show. It's a mission, frankly. It's a mission to share with people that, look, there's another option. You can build wealth with your personal bank. People have done it for decades and decades and decades. Okay? Again, we have companies that have been paying 6% dividends for the past 25 years plus and have never missed a dividend since before the Civil War. I mean, I don't mean to pick on anybody, but when people talk about dividend-paying stocks or fixed income and things like that, I kind of almost have to chuckle because the granddaddy of them all are insurance companies that have been paying dividends for well over a century without ever missing, without skipping a beat, including things like the Civil War or the Great Depression or multiple world wars or the high interest rate, anything you want to put in there, the high interest rates of the 70s, whatever. They never missed. They're well positioned to continue to pay those dividends for the foreseeable future. A-plus rated, name company, multi-billion-dollar companies. They're the granddaddy of them all for fixed income, guaranteed type income. But to make things even better, you get tax benefits out of it. You can grow your money income tax free. You can access it tax free. This is something a lot of people don't realize. And of course, pass it on income tax free to your heirs. Again, it has to be set up properly to accomplish this, but we certainly can quite easily do that. And we'll also share with you how to do it right. One of the other comments I had from a listener recently is they were saying, well, I understand setting up the insurance policy to get the dividends and then access the funds for the bank line of credit and get the positive arbitrage. That's all great, but I don't want to deal with a complicated insurance policy. Well, guess what? That's another fallacy that's been foisted on the American public. These are not complicated contracts at all. In fact, these are some of the simplest contracts, financial contracts, documents you'll ever see. I mean, I ask people this all the time. Have you ever read a mutual fund prospectus? I mean, they're at least 100 pages, if not more, right? Who reads those things? I mean, frankly, they're set up by lawyers, right, to protect the companies. I mean, in typical policy, insurance policy is 20 pages or so at most. And it's mostly words and definitions, like what's a beneficiary, which most everyone understands. So these are much more simple than most people realize. Also, they're much easier to get than most people realize. There's another conversation I had literally today with a radio listener. He said, it's almost counterintuitive. He's nearing 70, nearing retirement. And he says, and looking at and getting life insurance, he said, I like what you're saying, and I like your outlook, and it's different, and it's fresh, and I like that. In fact, that's the comment I get all the time. It's a different perspective, and the idea of diversification really appeals to me. But it's almost like counterintuitive for somebody who's nearing 70 to look at life insurance. And I said, you're right if you're looking at using life insurance for the traditional purpose that most people use it for, which is death benefit protection. You see, I always tell people, look, if you're trying to use it as a death benefit protection tool, the cost of insurance, of course, is going to cost more for somebody who's older. But the thing is, we're not trying to do that here. We're doing exactly the opposite. We're maximizing the cash and minimizing the death benefit. We can reduce it by as much as 90% of what's typical. In other words, the rest is cash, isn't it? So what's happened is you're going for a much smaller policy, a much lower cost of insurance, 50 to 90% lower, by the way. as a result. It's much easier to qualify for. And in fact, I even asked him, have you had any major health issues the last 5 years? He's like, no. Are you any prescriptions? No. I said, I'm going to tell you, you're probably going to qualify. It's pretty, almost not guaranteed, but highly likely. And even if you're not, I've gotten folks qualified who've had cancer, 5 years ago or whatever. Okay, and the numbers still worked. So that's another thing I want people to understand. There's some other misconceptions about this that I want to clear up. Again, if you're not comfortable with risk, and a lot of people are not, it's okay. And you can still build wealth. I mean, the stock market isn't the only game in town. Real estate isn't the only option to build wealth. Neither is cryptocurrency or precious metals for that matter. There are other ways to build wealth and not have to take on market risk. Your personal bank is one of them, okay? The key is understanding compound interest and consistent, steady growth over a period of time. And folks, by the way, that applies with any type of asset or investment, doesn't it? And in fact, with your personal bank, with the steady, consistent nature of the dividends that get paid each and every single year, compound interest actually works for you even better than an investment that maybe has a higher average rate of return but has some negative years in there. I mean, do you realize those negative years kill the compounding effect? You're actually better off. It's the turtle and the hare. Many times with the consistency of every single year. Yes, it might be more boring, not as exciting. It's not as sexy. I hear that sometimes. And I tell people, that's the reason why it's so successful. That's what we love about it. So stay tuned in the next segment. I'm going to go into further about this and about diversification and why it's so important.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. And I just realized I'm entitling this show, There's More Than One Way to Skin a Cat. And I realized, I'm showing my Midwestern roots, by the way. It's a common phrase or saying there. And we would never do that. I mean, I don't want somebody calling it saying we're picking on cats. Okay, I love cats. I love animals. It's just a phrase. And so, in other words, it means there's more than one way to do something or accomplish something. So please don't call in and give me a hard time. I didn't mean anything bad by it. My daughter asked me to say that, just so you know. She heard this and like, oh my gosh. Anyway, like I said, what we've been talking about a lot today, and again, you can go back to the previously recorded shows on yourpersonalbank.com anytime. Titles of each one are there. Or pass it on to anybody. We really encourage you to do that. Here's the thing. A lot of people out there are really not comfortable with the risk. And the most common thing people think about with retirement planning and that kind of thing, of course, is the stock market. A lot of folks are just not comfortable with that level of risk, or maybe they were, but not so much more as things get more frothy. Maybe as that's, nearing all-time highs or at all-time highs and various things like that. And that's okay. And also, I've said this before, if you are comfortable with that, that's okay too, but you should still consider diversification. And what I mean, I'm going to talk about this further, is diversification in a non-correlated asset. See, I get this all the time. I talk to folks and it's amazing how often when I do meet with somebody, how much of their net worth is involved in the markets. Oftentimes, it's all of it. Basically, all of their liquid net worth is in the markets. And of course, has it worked out for a lot of folks? Sure. Has it not worked for others? Absolutely. The thing is, and they'll say, well, have you looked at or considered diversification? And then typically the response I'll get is, oh, well, yeah, I'm diversifying this sector and that sector. I'll say, no, that's not what I mean. Diversification, you got to understand, I've been in the financial industry over 20 years. And you go back 20 years, diversification didn't mean, for the most people, when you said that, it didn't mean different sectors. It meant you had some money in real estate, or you had some in your business, or maybe you had some money in the banks and CDs and stuff. Not so much today because of interest rates, of course, but that was much more common, okay, back then. Diversification, and the reason why diversifying in different sectors, although in a typical market can work, in a more extreme environment doesn't so much. I mean, wasn't that long ago, about a year ago, when we had the sell-off due to COVID. 30 days, we saw about a 30% drop pretty much across the board. I remember one of the shows where I believe that month showed that there was one stock in the Fortune 5, I think it was the S&P 500 that didn't go down. One. So basically a rising tide raises all ships, basically, and a lowering tide pulls them all out. We saw basically the same thing in 08 and 09. Very, very few stocks and companies didn't suffer from all that. Non-correlated assets, diversification into a non-correlated asset means you're diversified into an asset that doesn't have the same correlation, or its value is not affected by the same factors. A typical example, or common one we hear, is real estate. The stock market and the real estate markets tend to, but not always, used to more so, divert from each other. If one was good, high interest rates in general was bad for the markets and good and good for real estate and vice versa. Okay, they've kind of been integrated a lot more than used to, and we found that out in 08, 09, how integrated they can be. Some people tout precious metals, some cryptocurrencies, businesses, for example. A business can certainly be non-correlated, but it's affected by the overall economy, as most businesses are, as we saw through COVID, or many, I should say. Some do well, others really suffered. It can still be correlated. So you could have a retirement account, investments, whatever, and own a business, and both suffered. We saw a lot of that this past year with folks. Fixed income is often touted as an alternative or diversification, and it can be if it has some guarantees or underlying safety. The problem is, where do you go with today's low interest rate environment? That's the huge challenge. I actually heard somebody talk about recently, and I believe this is accurate. We're in the lowest interest rate environment since 1787. By the way, that's when the Constitution was adopted. That's basically the beginning of our country. So that kind of puts things in a little bit of perspective of how low our interest rate environment is. So if you were looking for diversification in a non-correlated asset, having something with some guarantees is important, and getting a decent rate of return. Like I said, we have 6% dividend paying companies. I'm going to encourage you to stay tuned in the next segment. We're going to talk more about that solution, so stay tuned.
For more information on Your Personal Bank, feel free to contact Ference at yourpersonalbank.com. Back to the Your Personal Bank Show with Ference Toth.
Welcome back to the Your Personal Bank Show. We're rounding third and wrapping this up. And like I said, today we're really talking about, there's more than one way to accomplish your financial goals. And what I really mean by that, and this comes from a lot of listeners that I've been talking to. A lot of folks have been saying, look, I really like that you're sharing some different ideas, some other alternatives, not necessarily just everything in the market, okay? And I'm not saying that's bad necessarily, but if that's the exclusive, if that's only thing, so I've heard some people say it's the only game in town. Well, I got news for you. There are other games. In fact, it's not even the biggest game in town. The bond market, for example, is bigger than the stock market. Currency trading is huge, probably much bigger. There's real estate certainly overall is a bigger market than the stock market, depending on how you measure it. But certainly huge markets, huge opportunities. So I think that's a little self-serving, but whatever. The key is this. I'm not saying the stock market is bad in and of itself. It can be a great tool to grow wealth, but there are other tools to grow wealth also. And if you have most, if not all of your monies in one place, whether it is all in the stock market or whether it's all in real estate or cryptocurrency or precious metals or anything else for that matter. I see a lot of business owners have their entire net worth wrapped up in their business. Now, I understand that it's their baby. You know what I mean? I'm a business owner. I get it. But to have everything wrapped up in that business is, well, it's risky. And it's risky from a diversification standpoint. To build wealth, you want to diversify. You want to avoid the risk of, in case one thing goes down, you've got another avenue. But you want to diversify not just in like different sectors often here, but you want to diversify into non-correlated assets. So I want to touch on some of the most common ones, the most popular ones we hear about all the time. I mean, obviously we've talked a lot about the markets, and most people understand either they're involved with it, whatever, or they're not, and they're either comfortable with that risk or they're not. And I want everybody to understand that, look, if you're not comfortable with that level of risk, that's okay. In fact, the majority of human beings are not. The human behavior studies show that over and over again. That's okay. There are other ways to build wealth that don't require that level of risk, okay? Real estate is one of the most common alternatives that we all hear about. Now, can you build wealth through real estate? I don't think anyone can argue against that. Now, is it for everyone? No. Not everybody wants to get into that arena or learn what it takes or do what it takes to do. And there's many different aspects of real estate too. I've done many of them myself. Anything from buy and holds and rentals and multifamily and fix and flips and all the. So when somebody says to me, "Well, I want to do real estate," I'll typically ask them, "Well, what area are you referring to?" Because they're so different. Okay, but some of the things that are affecting real estate in general, kind of across the board right now, is some of the moratorium. You know, the moratoriums that we have, they're set to expire at the end of March, at least at this point. That has a lot of big real estate investors really concerned. In fact, some of the terms I've heard from some of them is they're scared to death. Some of the latest statistics I've seen nationwide is that about 10% of mortgage holders are not paying their mortgage, and about 20% of renters are not. Now, of course, different areas and different markets are going to be affected by that. But even if the numbers end up being half that or even a quarter of that, that's going to have a major impact on the markets, when those expire. What are those people going to get caught up? Are they going to get foreclosed on or evicted and have to move elsewhere? That all remains to be seen. And there's a lot of uncertainty right now in the real estate market. And I'm not a real estate expert. I'll say that straight off that. I've done a lot of it personally, but I think the concerns with the moratorium are enough that it's probably a good idea to at least pause for a bit and wait and see. I know some people don't want to hear that, but it's probably a good idea. Again, that's everybody's own decision, of course, in that area, because I'm not a real estate expert. Actually, next month, I have one of those experts going to be interviewing. We're going to talk about some of those very things shortly before the moratoriums occur, so it'll be interesting. The other part of it is on the commercial side of real estate. Certainly, it's pretty obvious there's some concerns there because of the whole stay-at-home movement. So many people not working from or going to work because of COVID shutdowns, and many have been working from home now for about a year, and companies have made it work. And many companies have come to realize it's more efficient, less overhead, smaller footprint in terms of office space that they need. So how many of those are going to, when the COVID restrictions are finally gone, how many people are going to really come back to work? That remains to be seen. And how many office buildings are going to have vacancy? That's a big unknown and I think a big concern. So we're going to have to watch and wait and see. But I think if you're going to look at investing in commercial real estate, again, might want to take a bit of a pause and see what happens. Now, another area, and the last thing on real estate, and I can share this from my banking experience side, is lending is tight right now. Okay, it's harder to get a loan than it's been in quite some time. And again, the reason is the banking industry has great concerns about these very things with the moratoriums and the commercial real estate space, because banking primarily does a lot of residential and commercial lending. So they're very, very concerned about that And that's why lending standards have been increased. And it's tighter, harder to get a loan, which slows everything down. Okay. So there's a lack of inventory. I get that in most places. And prices are high. I understand that too. But there's these problems that are on the near horizon that are of concern. We'll put it that way. Proceed with caution. Maybe that's a good way to look at it. Cryptocurrency these days in particular is brought as an alternative for investing. The thing is, and I'm not saying it's a bad thing, and those that are cryptocurrency fans sometimes can be almost fanatics, if you know what I mean. And I think it is going to be a part of our future. I'm not saying it isn't, but it's still new for a lot of people and something that's not really understand. And people in general don't grab onto something that they struggle to understand. Secondly, it still is not tied to anything in terms of value. I mean, you can argue about what our currency is actually worth and all, but it is backed by the full faith of the government, for example. And you can go and take a dollar bill and go buy something with it today. A Bitcoin is a lot harder to try to exchange it for a tangible item. And until that changes, I think its place is going to be limited. It's very volatile. And then, of course, there's a lot of fraud. I read about all the time where so-and-so lost so much Bitcoin because of a fraud or lost their keys or this or that. And so those are just not good things to be accepted mainstream, if you know what I mean. So again, I'm not saying don't invest in cryptocurrency, but it's probably more risky than the markets are even in real estate right now. And again, just proceed with caution, right? Precious metals, again, is another thing that's often touted for alternative to currency and things like that. And certainly in some respects it can be. But the thing is, if you look at the charts and history of precious metals, they're very volatile. And a lot of that is because they're primarily controlled, particularly gold, is controlled by the major world banks. They really hold the biggest chunk of gold in the world. And so if a Bank of China decides to sell several tons of gold, literally, I mean, that can impact the price overnight. So there's a lot of volatility in the precious metals markets. And like this recent GameStop thing where some people were saying the Redditors were going to go and try to short silver. Well, even the Redditors knew that was a joke. You can't short silver. There's too many people involved. It's too big. It's controlled by big banks. That was really just the facade. Okay. Businesses. Can you invest in a business? Absolutely. Certainly. And many businesses can succeed greatly, but again, many businesses fail. We all know we've all heard the statistics. According to the Small Business Administration, they state that about 50% of all small businesses fail in the first 5 years. And of course, the COVID shutdowns has accelerated many types of businesses. So that can be a struggle there, if you know what I mean. And so that's why when you and then you look at fixed income, that's another big one. The problem today with many fixed income instruments is simply that the interest rates are so low. Again, I heard recently somebody say that our current interest rates are the lowest they've been ever since 1787. It was basically their way of saying this is the lowest interest rate environment we've ever seen in the history of our country, over 200 years. So if you're trying to retire on fixed income and trying to live off of fixed income, congratulations. You're doing it in the lowest interest rate environment ever for our country's history. Now, what can you do about it? Why do people do that, the fixed income? Well, it's because of the consistency, the consistent income is what they're looking for, and a degree of safety. When you look in the fixed income arenas, I've talked about this in previous shows. And again, I always encourage, go to yourpersonalbank.com, listen to any of the previously recorded shows, and you'll find all kinds of topics, pass it on, listen to it. Contact me if you want more information, obviously. Be happy to discuss this with you. The personal bank dividends are still, the policies got 6% today, 2021. That's incredible when you compare that to other fixed products out there like mini bonds or have anybody looked at a CD lately? The interest rates that you get on a 1-year CD or a 5-year CD even are ridiculous. How about the interest ridiculously low? How about the interest rate on a bank account or checking or high interest, quote unquote, high interest savings account? I'm seeing these all over the place, high interest money market accounts and things like that. Yes, they're safe. They have guarantees, but their interest rate that folks are earning are a 0 point something. In other words, less than 1%. It's really hard to retire on income, fixed income, when maybe you're earning 1% or less on it, obviously. My point is 6% dividends is a very fair, strong rate in comparison to other ones, especially today. And then when you add on to the extra caveat of bringing in the bank line of credit, you have a high cash value policy paying a strong dividends and have since before the Civil War, literally. And you couple that with the bank line of credit where you're getting charged between 3 and 3.95. That's the current rates today. And when you spend your money, when you spend the dollars, you actually use them, you're still picking up a 2 or 3% positive arbitrage. I have folks who have been transferring high interest savings accounts, quote unquote, high interest, putting them into personal banks, accessing the funds from the line of credit to supplement retirement or invest in other things or whatever. And the positive arbitrage alone is higher than what they were earning before. And they spent all the money. Think about that a minute. That's why I'm saying I really encourage you, contact me at yourpersonalbank.com. Let me discuss how this can work for you. Like I said in the first segment, I was talking to this gentleman earlier today where he was nearing 70. And he was like, looking at life insurance at my age is counterintuitive. I said, I understand. But if you're looking for some guarantees and consistency, and you're looking for some tax benefits, and you're looking for access and use of your money and pick up positive arbitrage on top of it, I'm not aware of anywhere else you can go to accomplish all those things. And he agreed. And that's why he's looking at and seriously considering this as an option, as have many, many others. I have hundreds and hundreds of clients over the last number of years that have done this and are continuing to do this and looking at enhancing their financial future at a time where it's extremely difficult to do so. So as always, stay tuned and we'll talk to you next week.
Listen Tuesday at noon and Thursdays at 1 for more information on Your Personal Bank. Contact Ference at yourpersonalbank.com. This show is designed to provide accurate and authoritative information. The presenter and guest on this program do not engage in legal, accounting, or tax advice. Professional advice regarding your situation should be sought if required. Products and riders may have limitations and may not be available in all states. Excessive unpaid loans may affect performance. Distributions may become taxable if not managed properly. Replacements may not be suitable for everyone. There may be charges when replacing coverage. Compare when considering a replacement. Dividend rates and baseline of credit rates may change. Contact yourpersonalbank.com for current rates.